Hantec Markets piyasa analisti Richard Perry bizleri bekliyor. Richard, good afternoon.
Good afternoon.
We just saw PPI numbers from United States right now, which are better than expectations, higher than expectations. But we also saw a weaker side on the retail sales as well. Which one do you expect to markets to price more?
Well, certainly I think they both have their importance, and retail sales have been pretty positive for the States. They've been around about 4.5% last year, and they've maintained that traction into 2018. But I think the markets are still focused on inflation, and obviously playing into that, we had the CPI data yesterday that was a little bit subdued. So the PPI might well sort of give the dollar a little bit of a lift if it's come in better than expectations. I've not actually seen the data yet myself. However, I think that what we are seeing is a very sort of a mixed set of data points coming through at the moment. That was sort of indicative of the non-farm payrolls data that we got on Friday. The market didn't really know how to play that because at the moment we're not really seeing the inflation coming through in the hard data. PPI has picked up, as you said, but the CPI did not pick up yesterday. So there's going to be some mixed reaction, I think, to that fact. At the moment, we've got the dollar, which is sort of trading in a fairly sort of quiet range. It sort of got hit yesterday afternoon from the protectionist fears, but generally speaking, the dollar is fairly settled at the moment. But I think on a longer-term basis, we still remain dollar negative due to the longer-term structural negative facts of the twin deficits in the United States, which continue to deteriorate.
If you're talking about dollar's weakness, what can you say about that? Because if you're expecting more weakness than that we see right now, a dollar index below 89s or so, what will it be depend on? And also, do you somehow add Trump policies and administration's uncertainties on that manner as well?
I think just on the longer term aspects of the dollar, we continue to see Trump's trade tariffs as being a negative. I don't think it's going to ultimately help his the twin deficits, which, as I said, continue to deteriorate, because you've got the second round effects of the trade tariffs. Certainly, you've got the EU, which are contemplating their big 100 list of potential tariffs they're going to put on, and apparently Donald Trump is considering around maybe even up to 60 billion worth of trade tariffs on China as well, and China are certainly not going to react positively to that. So the problem with the trade tariffs is you get the second round effect, which negates the potential positives that you could get out of using trade tariffs. So subsequently you get the negative aspect of economic growth. General trade around the world is going to deteriorate, and I think subsequently we're going to see the dollar coming off on the back of that. And so subsequently, longer term, we still see the twin deficits as worsening, and that is going to be the big pull on the dollar as the year continues to drag forward.
And what's your take on the U.S. Treasuries? They are struggling to move above 290s right now. Do you expect that to move there or further in the near future if we see some signs of more inflation?
Well, I think, the two topics that we've really been talking about just now is inflation and protectionism, and they are two sort of aspects on Treasury yields that could be a balancing effect. Because obviously, if we do start to see inflation picking up, that's going to pull the 10-year yield higher towards 3%. But on top of that, as you saw yesterday, if we see the protectionism coming through from Donald Trump, then we're going to see the 10-year yield being dragged back. So we could see the 10-year yield ultimately sort of trading, around this sort of 2.8, maybe up towards 3% area for the time to come. And that's, again, not going to help the dollar going forward, because ultimately, at the moment, the dollar is not really reacting to rising Treasury yields. It's sort of more on the fears of the economic structural negatives that I've just laid out.
The last question is the liquidity side, because when we look at the 3-month LIBOR, it's moving it's at the highest level since 2008, and when we look at LIBOR OIS spread, it's just around the levels that we've seen during Eurozone crisis. So do you believe that will add some uncertainties on the emerging market perspective, including Turkey as well?
Yeah, I think that the sort of arguments that you can have in terms of emerging markets is if we start to see these rates going higher, that's going to ultimately sort of play into emerging markets on a negative side. And what you have seen in the last sort of couple of months is as the yields on Treasuries have started to pull higher, you've seen the Turkish lira start to depreciate against the dollar. We saw yesterday a breakout on the Turkish on the dollar versus the Turkish above 2.85%, which is 3.85, which was a key level on a sort of near to medium term basis, and that could continue to move towards 4. And I think that is a key level that ultimately we'll be looking out for in the coming weeks and months if we start to continue to see these LIBOR rates and Treasury yields moving higher. But at the moment, we're certainly starting to see these protectionist aspects coming into the market, and that's not going to help emerging market currencies such as the Turkish lira, and if that continues.
Richard Perry, thank you very much for joining us today.